Fed kicking off that two-day meeting. Day one today. Steve Liesman joins us with the latest results from our CNBC Fed Survey. Morning, Steve.
Yeah, Sarah, good morning. And we'll get to the split between doves and hawks in a second. But first, let's look at the outlook for stocks in our CNBC Fed Survey. You can see where we were. This was the outlook for 2019 back in our June survey, kind of downbeat. And it's come up a little bit with the market. Now we're looking for 30.59 by the end of 2019. Let's take a look at what that means relative to where we are and where we're going. Currently, 302, that was closed yesterday, and going up to 31.67 by 2020, 5%. You know, not too bad relative to how it could be. But that comes in a context of the market. The respondents think that perhaps the yields have overshot where they're going to be. Obviously, the outlook for yields has come way down over time. We're at 205 now, but over time, they think there's a little bit more rise in yields coming, and that comes, by the way, with a little bit slower growth. This is what's built in. Take a look at the growth outlook. We did 2.5 Q4 over Q4 in 2018, going to 2.3, going to 2.1. The potential growth is right around where that 2.3 number is right there. So in and around potential, but not a recession in the offing. Talked about the split on the street over this rate cut. Everybody thinks the Fed is cutting rates, but differences of opinion on whether the Fed should cut rates. 48% say the Fed should not cut. 50%, there were 41 respondents, by the way. 50% say the Fed should cut. Of those, of the total, 13% say it should be 50. Most think it's going to be a 25 basis point cut. Here's some of the split that's out there. John Qatar, Chief Investment Officer of Arden, says, objectively, the case for rate cut is not obvious. The economic data, as Sarah just said, has simply not been weak enough, and the absolute level of rates is already low. But then Lindsay Piegza from Stifel writes, cautiously building a cushion against potential future troubles is arguably the most appropriate pathway near term. Guys, we're going to be arguing about this for a while, but all the argument, I think, matters not that much because I think the Fed's cutting rates.
Yeah. Steve, I got to ask you about, earlier in the week, the Times did this piece on recessionary indicators. One of them was when consumer sentiment falls 15%. That's not the way Conference Board's going.
No, and did you see the income and spending numbers this morning? They were pretty good. The confidence numbers were good. The one weakness in the economy, if you're just following the data, is the capital spending numbers. Of course, those are based on higher numbers from 2018. And the corporate profit numbers also are on the weak side. But it's going to be very hard to have the kind of weakness that you might expect in the face of a rate cut. Look, Carl, I think thinking about this rate cut in terms of the actual economic data is very difficult. The best way to think about it is an insurance cut.
Yeah, and also inflation is missed, as marked short.
Yeah,
that's a point the
we
White
could
House
argue about how much we're missing and whether or not. I mean, what that administration
and which
official,
direction it's going into.
Right, that administration official just on your air changed the mandate of the Fed. Right, they want to focus on inflation, but the Fed mandate is both inflation and employment.
Yeah, and they want to focus on overseas rates as well.